This is The Gist, the essential podcast for the discerning listener.
Welcome to The Gist. It is Thursday, July 30th, 2026. I am John.
And I am Mary. We are your smart friends on the go. Let us get right into it.
We are starting with a fascinating look at the tech world. Samsung just dropped its second quarter earnings. The numbers tell a clear story about who holds the power in the artificial intelligence boom.
Here is the headline. Samsung's semiconductor division, the people making the microchips, posted an operating profit of 89.2 trillion won. That is about 61.7 billion United States dollars.
It is a 250-fold jump from last year. Massive! But here is the twist. Samsung also makes smartphones, and that consumer phone unit just posted its first ever operating loss.
They lost 700 billion won. Why? It comes down to how Samsung is structured. The chip division treats the smartphone division like an outside buyer. They charge their own phone designers full market rates for memory chips.
Think of a restaurant. The kitchen buys tomatoes from its own garden, but the garden charges the kitchen triple the price. Why? Because tomatoes are suddenly in high demand everywhere else.
Exactly. And that everywhere else means enterprise data centers. Big tech companies are buying up all the silicon to build massive artificial intelligence infrastructure.
They are outbidding the consumer device market. This is a massive shift in resource flows. The money and power are moving away from the gadget in your pocket. They are flowing directly into giant corporate data centers.
And this is not a quick blip. Samsung executives are warning that artificial intelligence chip shortages will get worse through 2027 and 2028. Smartphone prices will eventually have to rise just to cover these internal costs.
Moving to the global overview, let us look at the money supply. The United States Federal Reserve held interest rates steady on July 29.
This means borrowing money is not getting any cheaper right now. When the Fed keeps rates high, investors often look for safe places to park their wealth.
Right, which is why gold prices went up in Asian trading right after the news.
Let us pivot to science and innovation. The United States government is changing how it funds research. The National Science Foundation, an independent agency that usually funds basic, unrestricted research, just launched a $47 million pilot program.
This program pays for 250 technical PhD students to spend a year working at corporate partners.
At the same time, NASA has a program called NIAC. That stands for Innovative Advanced Concepts. It funds early-stage aerospace tech. They just handed out $3.2 million across 18 grants.
Here is the power dynamic at play. Public funding is shifting. The government is moving away from pure, curious exploration. They want immediate commercial utility.
Yes, the state is essentially subsidizing research and development for private corporations. It is a clear push to turn public science into applied, market-ready products.
Time for the European perspective. Let us talk about demographics. We hear this everywhere. An aging population will destroy the economy.
But a new study says otherwise. The Centre for Economic Policy Research, or CEPR, is a major network of European economists. They looked at 70 years of data.
Their finding, shrinking birth rates do not hurt overall economic growth. In fact, countries with lower birth rates see higher GDP growth per working age adult.
The same is true for wages. In the United States, areas with lower birth rates actually saw faster wage growth.
Let us look at the incentives. A shrinking labour pool means fewer workers. Fewer workers mean companies are forced to adopt new technology faster.
Right. Machines pick up the slack. This tech adoption drives up productivity per person. It completely offsets the missing workers. Workers gain more leverage and higher pay.
But there is a catch. It is about the resource flow for pensions. Technology can boost wages, but an aging population means fewer actual taxpayers.
Exactly. So while workers get paid more, the absolute tax base shrinks. That makes it much harder to fund pay-as-you-go retirement systems. It is a harsh fiscal reality.
Switching gears to digital banking, another study from the CEPR shows that digital app-based banks raise interest rates for savers much faster than traditional banks.
Why? 2 words. Social media. Depositors are hyper-aware now. If an online bank does not raise its savings rate, customers notice instantly. They complain online, then they move their money with a few taps on their phone.
The power rests with the retail depositor. Digital banks have to pay higher rates to keep their cash.
Finally, a sober update on the war in Ukraine. Kyiv's strategy of economic attrition is working. Ukrainian drone strikes on Russian oil refineries are causing massive damage.
The impact is visible from space, even months later. This directly chokes Russia's economic resource flows.
However, Russia retaliated heavily. On July 30th, they launched dozens of missiles and hundreds of drones at western Ukrainian cities.
That brings us to today's temperature. We are seeing a world defined by its bottlenecks. A shortage of artificial intelligence chips is driving up consumer prices and shifting tech dominance to data centers. A shortage of workers is forcing companies to automate, boosting wages but stressing pension funds. Across the board, constraint is acting as a brutal but highly effective catalyst for change.
It certainly is. Well, that is the gist for today.
If you enjoyed listening and want to stay a step ahead, come join our daily newsletter. It is completely free. Just tap the subscribe link right there in the show notes. We would love to have you. Talk to you tomorrow.
The Gist, News Digest, and podcast are entirely written and produced by artificial intelligence. The Gist is out 3 times a day, every day, providing you with a liberal perspective on what to expect next. For more information and donations, visit thegist.online. Thank you for listening.